I'm looking at the Bloomberg World Bank Index. That index is down about 4%. It's the biggest decline since June 2020. And this particular index tracks more than 160 banking stocks across the globe. It has fallen for the fifth straight session. In fact, all the stocks are down from their 52-week high, and they're in the range of 2% and 79%, the kind of cuts we are seeing. In fact, First Republic Bank, that has tanked more than 70% as American markets have opened today. Meanwhile, the FDIC has transferred the deposits of SVB to a bridge bank. And President Biden has spoken. He's tried to assure Americans that their bank deposits are safe. Then, on the other hand, you have the Indian markets. We've seen massive losses in trade. The Nifty has lost almost 400 points from the kind of highs it saw during the day. So what do these losses, what does all this volatility mean for Indian investors? We're going to discuss this at length. But before that, let's listen in to the managing editor of etnow, his take on the Indian markets, as well as what President Biden has said on the banking crisis.
What is leading to this decline? And the decline, I guess, is very universal in nature. It is not restricted to just banks. It is defensives, IT, you would imagine autos. Very domestic looking markets are looking weak. I think that the selling today must have got triggered because of a large institutional selling that has broken the back of the Nifty. Up until now, we've been using the word range for this market, which is lower end of the range, market is finding support. At the upper end of the range, the market is finding resistance. Today, the range has been decisively broken. And when a range of a market which has been steady has been broken, it's just an indication of supply more than fundamental factors. Look at Adani group of stocks. Isn't it ironical? The problem started with Adani group of stocks.
No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Investors in the banks will not be protected. We must get the full accounting of what happened and why those responsible can be held accountable.
Words of reassurance coming in from the US President earlier this evening. Let's find out whether or not the market's fears are going to get allayed or not. For that, let's connect with Craig Erlam, Senior Market Analyst at Wanda, is joining us along with Aditya Shah, Chief Investment Officer at JST Investments. Craig and Aditya, thanks very much for making the time. To you first, Craig. How much has this fall that we're seeing of SVB and the kind of subsequent fallout affected sentiment on Wall Street? We are seeing big bleeding happening over there, and Biden has made that rather short attempt at reassuring everyone. Do you think it has helped at all?
Well, I think the efforts have helped a little bit, but I think there's two things probably on investors' mind right now. One is probably relief that the institutions necessary have stepped in order to try and shore up the issues which are clear at this point in time, and that the processes are in place in order to do so swiftly and strongly in order to deal with the immediate risk situation. But I think the other thing that's probably weighing on investors' mind right now is we still don't know the full contagion effects. We don't know where the other vulnerabilities lie, or it's certainly not clear at this point in time. And then there's going to be that nagging voice in the back of your mind that says, well, if these institutions are stepping in so firmly and so quickly over the course of this weekend, what else is it that they fear that we should be fearing? And this is always the situation in a situation of this kind. When you see something happen that happens so rapidly and in such large numbers, then the fear is going to play a bigger role ultimately than what you're necessarily understanding at this point in time. If we don't see any further signs of risk and contagion over the next 3 days, and similar to what we saw, for example, over the last 3 days, then I think sentiment will calm down and some rationality will return to the markets. But at this point in time, I think investors are simply in a defensive mode because they're waiting to see what exactly the full ramifications are going to be.
How deep do the fears run, Aditya? What's the fallout that you've seen in our part of the world? We have seen the markets collapse because of SVB largely. What have you seen so far, and what more should we expect according to you? What should we, like Craig is suggesting, what should we brace ourselves for?
I see in the US now, it is a financial stability risk with SVB, with Silvergate. We don't know the unintended consequences of the US Fed rate hike, and banks were simply unprepared for this interest rate hike. While on the other hand, US has been facing a lot of problems. In India, RBI has been already preparing the banks for the unintended consequences of interest rate hikes. Banks have been creating buffers so that when they suffer losses on their bond portfolios, they are able to cushion it from the profits that they've already made. So all in all, Indian banking system is resilient, strong, and we have learned from our share of failures in Yes Bank or a PMC Bank or a THFL. So all in all, the banking sector continues to be robust. RBI is continuously tracking the banking sector. However, the financial stability risk in the US, if it plays out, it will affect the stock markets across the world, and India is not immune to it. So you can find that the stock markets may correct, but as a whole, as a banking sector, as an economy, India continues to do extremely well, and that is very important. Markets can go down. However, if the fundamentals continue to remain strong, the market will eventually come back.
Right. So perhaps a temporary blip would be our best case scenario. But Craig, looking at the way the markets are behaving as far as HSBC is concerned, they've done a weekend deal for SVB in UK. But unlike the United States, Britain has not announced these broader liquidity measures for the banking system. How differently is the SVB collapse playing out elsewhere, like in the UK compared to the US?
Well, I think in the UK at this point in time, it looks a little bit more contained. And I think the HSBC deal makes a lot more sense for this particular situation in order to try and shore up confidence, ensure the taxpayer doesn't have to intervene, which I think is something that Rishi Sunak and the UK government has been keen to stress, that there's going to be no taxpayer element to this deal, and that the liquidity issue should remain sustainable, and that depositors will be able to get hold of their cash as and when they want it because of the deal that's been announced with HSBC. Of course, as I say, things can evolve over the next few days where that may change. But at this point in time, the announcement that we've seen from the UK, this swift action that we've seen from the UK government in conjunction with the Bank of England has been enough to shore up and create some stability in the short term. But as we saw, for example, even yesterday in the US with the other bank collapsing, the things can change quite rapidly. And that's, I think, what investors are almost effectively most fearful of right now. And I think it was important, really, that, yes, you know what, the Bank of England hasn't come out and given the same kind of assurances that the Federal Reserve has. But the Federal Reserve is ultimately world's reserve bank, or reserve central bank, and therefore it is always the first to offer these reassurances to ensure stability and liquidity in the markets, and it's done so again over the weekend.
Much has been said, Aditya, about interest rate hikes, and perhaps that being one of the key reasons why we have seen the kind of collapse in SVB and the fear of a contagion as well. What does that say about the future of interest rate hikes? Because we are in that cycle in most parts of the world, aren't we? Including India.
Definitely. So now the Fed is caught in two minds. I don't think that the US Fed can afford to slow down, because its fight against inflation will then take a backseat, and which will be a problem for the economy. So the US Fed cannot afford to slow down, point number one. Point number two is it has to continue to keep going until the inflation starts to come down. And the contagion risk is something that should have been thought much before the US Fed started to hike rates. Cushions should have been put in place. For example, in India, the RBI told the banks that whatever profits that you are making from the falling interest rates, you should keep them aside, so that when you incur losses, you are not in the need of capital. So RBI had taken proactive measures so that banks were protected from exactly this kind of scenario. So all in all, the Fed has a very, very difficult job to do now. It has to keep hiking interest rate until it gets inflation under control. At the same time, financial stability will continue to remain a challenge. We don't know from where the next surprise comes from. As you already know, the equity value of a lot of these banks is falling, which can be a cause of concern for a lot of these US banks if they require equity capital. So all in all, a very, very difficult task for the US, and accidents are waiting to happen, and we don't know from where the next accident comes from.
Well, Craig, many will be asking if lessons were learned at all from the 2008 financial crisis. How can we have this kind of bank collapse situation after such a mega event in this century itself? Biden refers to this as the risk of capitalism. What's your sense?
So I think there's a couple of things which we should highlight here where things have changed. One is the capital buffers that the largest banks do hold in order to create a buffer to this type of situation. That is vastly different to what we saw back in 2008. The downside to that, of course, is that the regulators do pay a lot more attention to the most systemic institutions within the US, and therefore smaller banks. We see less pressure on them to announce the same or achieve the same kinds of capital buffers, which means that they are where the potential risk lies. But that is how the US looks to contain the bigger, more widespread risk that we see within the US financial system. So I think that's one really important point. But as I alluded to earlier, I think the speed with which the Federal Reserve combined with the Treasury has come out and the FDIC has come out and announced such a swift response to what happened and what broke on Friday, I think that's a sign of the things that have been put in place since the global financial crisis to try and contain these situations rapidly and stop them spiraling out into a much bigger confidence issue where things start to unravel rapidly. They've managed to achieve this over a short weekend, and yes, we are seeing markets still in the red today, but if we see no further systemic issues materialize over the course of the next 48 hours, then I expect that will calm down as well. But as your other guest has just alluded to, the issue that we have is that this is not a clear-cut situation. It's not evident where other vulnerabilities are going to lie at this stage, if they do exist, and therefore it is unfortunately a case at this point of waiting and seeing what materializes.
And Aditya, as far as hedging risks are concerned, in this kind of market situation where it's ever evolving, you don't know exactly which way it's going to turn, if there are going to be any negative surprises. At that point in time, you want to believe that the big reliance that Indian banks have on local deposits, that will cushion them compared to global peers. The kind of potential contagion that they are facing from the SVB fallout, because of the strength of our local deposits, our domestic deposits, we may be a little more perhaps guarded. Do you believe that?
Definitely. So, as you know, I've been tracking the banking sector for 12 years. The banking sector has never been so strong. KV Kamath, who was a legendary founder of ICICI Bank, has not seen the banking sector so strong. Low NPAs, good credit growth, and deposits are coming back into the system as interest rates continue to keep increasing. People will move some bit of money from equities to fixed income. So my point is the Indian banking system is very strong. There is absolutely nothing to debate about on the Indian banking sector. Of course, bank stocks can fall as worldwide bank stocks take a beating, but that does not mean that there is a problem with the banking sector. We have had already our failures since 2018 when 3 or 4 big banks have failed and RBI has had to come and rescue them. So we have learned our lessons. We are moving on from this crisis, and if stock prices fall in India, it's an opportunity to buy into very high quality companies because systemically India is on a very strong.
What about you, Craig? What are you suggesting investors? How should they be hedging their risk? Should they stay away from the markets or looking at opportunities now?
I mean, we're seeing investors taking a very defensive stance at the start of this week, and I think that makes sense. In a situation where we are lacking clarity, I think it's always a very difficult market to invest into. Obviously, there's always going to be people who are going to see opportunity in these declines, and that's absolutely fine. I completely understand that case. But especially in the short term here, especially in areas where you've got the potential exposure, and as we've seen over the course of this weekend, for example, with SVB, but also 1 or 2 others as well. I think it's perfectly understandable to take a more defensive short-term stance because, like I say, it's so in these situations it's borderline impossible to see exactly where the exposure lands, and that for me that uncertainty that environment creates does lend itself to, like I say, a more defensive strategy in the short term.
In the short term, that's Craig's advice. Meanwhile, there is resilience from the Indian markets, is what Aditya has always believed, and he remains ever so positive. We'll have to keep marking all these statements and keep looking at what the markets really throw up in response to any kind of negative news that's coming in. And of course, we have seen that kind of proactive move to kind of hedge the possible fallout against the kind of crisis that we've seen in the banking sector with the fallout of SVB. Thanks very much, both Aditya and Craig, for joining us with your perspective on India tonight. Meanwhile, Silicon Valley Bank has many stakeholders in India. How is this going to impact those companies back home? Let's find out from our research team. Sharad Dubey is joining us to break it down for us. Sharad, how is it looking for these companies?
Well, yes, almost 20 companies are there in which SVB is actually invested in India. And of course, in the weekend, there was an important development coming in where Vijay Shekhar Sharma had stated that SVB is neither an investor, neither a current shareholder in Paytm. Now, of course, without Paytm also, we see the investments coming in, that's coming to the tune of almost $1.1 billion. So there are certain startups also having tie-ups over here, such as ChargeBee, Postman, CleverTap, where there is a financing or the banking relation is there with SVB as well. And apart from that, also Nazara Tech yesterday explained that almost $7.75 million of exposure is there amongst these two entities. Apart from that, also Y Combinator-led startups, especially from India, most of them have financing agreements with SVB. Now let's look at the numbers, how they actually pan out of the investments made by SVB in India. Next, Paytm, there are big names such as InMobi, Bharat Financial Inclusion, Naptol, and all these important startups which are there, which are having the tune of more than $100 million exposure as SVB is investing in India. Now you can see these numbers coming in your screen. Apart from that, also Bluestone and Tutor Vista make it to the list. Now this data has been coming from the latest updated data coming from Traxon. Now also Axel, that itself is a VC firm that is also having almost 35 companies are having a tie-up with SVB on this, and that is something to watch out for. Apart from that, the question remains is what lies ahead for the Indian startups, and that's the important thing. This includes no new recent round of funding has actually happened by SVB, and the fundings which have happened were on low ticket sizes. Apart from this, the most SaaS companies in India which are having large exposure in US, they do have credit lines with SVB, and sentimentally there might be an impact as over the weekend the US VCs asked the founders to withdraw or limit their exposure to SVB. But what are the ecosystem members stating about it, and especially in the theme of India itself? Let me explain you that VCs are saying that there is enough dry powder in the system in the Indian accounts as of now. Apart from that, the government also will start meeting startups this week to discuss the impact of the SVB crisis, and Fed also actually stated today earlier in the morning that they'll be making available the additional funding for the startups. And lastly, even the UK's PM also stated that there won't be any contagion risk.
All right, thanks very much for putting that in perspective for us. Contagion or